decision involved a massive leveraged position in a single financial instrument. Such positions amplify gains but can lead to total loss if the market moves against them. The pressure came from margin calls, which demand immediate cash to cover potential losses. Failing to meet a margin call forces the automatic liquidation of assets at market prices. This mechanism is common in high finance, but rarely triggers losses of this magnitude. Comparatively, market crashes typically unfold over days or weeks, not hours. The speed of the loss highlights the extreme risk concentration in the portfolio. It serves as a stark case study in the perils of unchecked leverage during volatility. A family office is a private firm that manages investments and affairs for an ultra-wealthy individual and their relatives. Unlike a hedge fund with outside investors, its sole client is the family itself, concentrating immense capital. This structure also concentrates absolute risk, as all assets and decisions are centralized within one entity. The mechanisms designed to protect vast wealth, like concentrated control and specialized management, can become vulnerabilities. Under the wrong circumstances, such as poor investment decisions or lack of oversight, these same protections can destroy wealth completely. This pattern is not unique. Similar downfalls have occurred when risk management fails in highly concentrated financial structures. The absence of external investors means there are fewer checks and balances compared to traditional investment funds. Thus, the family office model exemplifies how financial safeguards, when mismanaged, can lead to total loss. The family office's fortune was largely tied to complex financial instruments rather than simple cash or stocks. This approach amplified both potential gains and risks during periods of market volatility. Margin calls occur when the value of leveraged investments falls below required levels, forcing immediate repayment. For highly leveraged positions, even moderate market movements can trigger substantial margin requirements. The late 2010s saw increased market volatility affecting various asset classes simultaneously. Separate financial pressures from other ventures reduced available liquidity to meet margin requirements. Complex financial positions often lack the immediate liquidity of cash or easily traded stocks. This created a perfect storm where market movements, leverage, and external pressures converged. The financial structure was built on complex, leveraged positions. Essentially, huge bets on the market made with borrowed money. These positions required maintaining a specific value, known as collateral, to secure the loans from the banks. When market movements went against these positions, the value of the collateral fell below required thresholds. The banks that had lent the money then issued a margin call, a formal demand for additional cash to secure the loans. This demand was not a request, but a requirement for a massive, immediate infusion of capital. Failure to meet this demand typically triggers automatic liquidation of the leveraged positions by the lenders. This mechanism is a standard but high-risk feature of leveraged investing, amplifying both gains and losses. The sudden need for such a large sum of cash under pressure often creates an insurmountable financial crisis. The family faced a liquidity crisis, needing billions in cash immediately. Their wealth was largely illiquid, tied up in assets that couldn't be sold quickly. Private company stakes represented significant value, but required complex negotiations to sell. Real estate holdings, while valuable, take months to sell at market prices. Selling these assets quickly would mean accepting massive discounts, sometimes 30 to 50% below value. Legal hurdles further complicated rapid asset liquidation, requiring court approvals and regulatory compliance. This liquidity trap is common among the ultra-wealthy, whose fortunes are concentrated in non-cash assets. The crisis revealed how paper wealth can evaporate when cash demands exceed liquid resources. Facing an urgent margin call with insufficient liquid assets, the principal authorized the family office to deploy an extreme financial instrument. This instrument was designed to function as insurance or a hedge against their other holdings, providing protection in theory. The mechanism involves complex derivatives that can amplify both protection and risk simultaneously. In volatile market conditions, such instruments can behave unpredictably, with outcomes diverging sharply from theoretical models. The deployment under these specific circumstances triggered an immediate and catastrophic effect. This represents a classic pattern where extreme financial tools, when used in desperation, can accelerate rather than prevent collapse. The irreversible nature of the move meant there was no recovery path once the mechanism was activated. Such scenarios demonstrate how sophisticated financial strategies can backfire dramatically when market conditions deviate from assumptions. The attempted move to provide stability instead triggered automatic selling mechanisms within the family office's accounts. These mechanisms were likely stop-loss orders or margin calls designed to limit losses but can create cascading effects. The forced liquidation began selling underlying assets at rapidly declining prices. This created a feedback loop where selling pressure drove prices lower, requiring more sales to cover losses. Such liquidation spirals are common in financial collapses. When leveraged positions unwind, the mounting losses became self-perpetuating as each sale depressed asset values further. This unwinding represents a classic pattern where protective measures can accelerate rather than prevent financial disaster. The backfire was spectacular, precisely because it involved automated systems operating without human intervention. The feedback loop refers to a self-reinforcing market mechanism where losses trigger further losses, often through automated trading systems. In high-frequency or algorithmic trading, such loops can escalate rapidly, liquidating positions faster than human intervention can respond. The complete equity wipeout in hours illustrates the extreme leverage and concentration of risk that can exist within family office portfolios. Family offices, managing wealth for ultra-high net worth individuals, sometimes employ aggressive strategies that amplify both gains and losses. The precise internal conversations and final trade authorization remain private, as is typical with confidential family office operations. Technical triggers in automated systems like stop-loss orders or margin calls can cascade, but the exact sequence here is undisclosed. This event mirrors patterns in other financial collapses, where opacity and high-risk exposure led to sudden, catastrophic losses. Without access to internal deliberations, the full narrative of decision-making and oversight failures remains incomplete. The full aftermath for the broader business empire, which operated separately, remains complex and not fully public. This complexity is common when a major financial failure occurs within a larger corporate structure. A critical clarification is necessary. This was not a case of fraud or embezzlement. Instead, it involved a legally permissible financial strategy that led to disastrous consequences. Such strategies often rely on leverage, market timing, or concentrated investments that can amplify losses. The pattern is one of catastrophic risk, not criminal intent, distinguishing it from many other financial downfalls. The legal permissibility of the actions adds a layer of tragic inevitability to the collapse. This creates a scenario where immense wealth can be destroyed through perfectly allowable yet profoundly flawed decision-making. This wasn't a simple case of picking the wrong stock. The core failure was in risk management, a misunderstanding of extreme danger. The strategy involved a highly leveraged, complex hedge. This structure became critically vulnerable during a liquidity crisis. Contrary to the rogue trader narrative, reports indicate the principal was directly involved in decision-making. This highlights a pattern where sophisticated financial tools can amplify losses when market conditions shift. Leverage, while powerful for gains, acts as a multiplier for risk during downturns. The event serves as a case study in the catastrophic potential of misjudged financial engineering. The practical insight here is about the architecture of risk. First, liquidity over illusion. An asset's stated value on paper is meaningless if you cannot sell it during a crisis. This is a common pitfall where theoretical wealth meets practical reality. Diversification must include liquidity, access to cash, or easily sold securities. Without this, a portfolio is vulnerable, no matter how large it appears on a balance sheet. It's the difference between having resources and having usable resources when pressure hits. This principle applies universally, from personal finance to the largest corporate structures. Leverage, the use of borrowed money to amplify investment positions, creates a precarious financial structure. While it can multiply gains during favorable markets, it equally multiplies losses when markets turn. This financial control shifts partially to creditors, whose primary interest is protecting their own capital, not the borrower's survival. During market stress, sophisticated financial instruments often behave in ways that contradict theoretical models. The high pressure and emotional intensity of a crisis can cause even well-designed strategies to disintegrate rapidly. This combination of amplified risk through leverage and unpredictable instrument behavior during stress has contributed to numerous documented financial collapses. Wealth creation often rewards bold, aggressive instincts, taking calculated risks to build empires. Yet wealth preservation requires a different discipline: restraint, caution, and sometimes painful acceptance. In a crisis, the instinct to aggressively defend one's position or double down can be catastrophic. Complex financial engineering, designed to solve problems, can instead create irreversible traps. This pattern is visible in historical financial collapses where leverage and overconfidence turn setbacks into ruin. The safest move is often to accept a significant loss early, a strategic retreat to ensure survival. This contradicts the wealth creation mindset, but protects against the single, catastrophic gamble. The ultimate lesson is that the psychology for building fortune is not the same as the discipline needed to keep it.